This is a tutorial on how to record inventory transactions. In this example, we're going to assume a perpetual inventory system. With a perpetual inventory system, we're going to record each purchase and each sale as it happens and try to calculate the cost of the sale right at the point of the sale. In this first example, we're going to be using the Fifo assumption. F-I-F-O. FIFO, the letters in FIFO stand for first in, not fist, first in, first out, and the out refers to sales. So basically what FIFO means is that we assume that the oldest units are sold first. Now, this is important. It doesn't really matter what happens in real life. Just under this FIFO assumption, we're just going to assume that whatever the oldest units we have on hand are going to be sold first. As you can see here, I have this inventory storage area up here, and the oldest units are going to be put to the left, and then as we acquire more units, they'll be put over here on the right. I have tokens over here on the right that represent different units of inventory. Each token represents 5 units of inventory. The yellow ones, the 5 units, cost $10 each. The green, they cost $12 each. The blue costs $13 each. The pink, $15, and the purple, $17 each. But each box represents 5 units of inventory. So getting started with our transactions, you can see here that when we come in on March 1st, we have a beginning inventory. There are 25 units that cost $10 each. We can see because they're colored yellow, and that is our oldest layer. And then we have a second oldest layer, 20 units that cost $12 each. So we can see we have our 4 boxes because each box represents 5 units. So when we add all of that together, our total 45 units have a cost of $490. So, excuse me, our general ledger would have a cost of $490 for that inventory as of the end of February or the beginning of March. Now let's assume that we have our first transaction on March 3rd. And that transaction is a purchase. And we're going to purchase 15 units at $12 each. So we can calculate the cost of the purchase. 15 times 12 gives us a cost of $180 for the purchase, and all we're going to do is debit inventory for $180 and credit accounts payable for the $180, the same $180. Very easy. So you're going to notice that when we purchase the inventory, we're now going to have another layer that we now have another 15 units that cost $12 each. Now the next thing that happens is on March 5th, we're going to sell 30 units at a price of $25 each. So now we have to calculate the cost of the sale. So once again, in this example, we are going to be working under the FIFO assumption. FIFO means first in, first out, and as I mentioned before, that means that we assume our oldest items are sold first. So given this, we want to take our we want to take out our 30 oldest units and allocate them to cost of goods sold. So our oldest units are the $10 each. So we'll bring all of our $10 units, 5, 10, 15, 20, and 25 units are given to the customer, but then the customer is going to say, hey, wait a minute, I asked you for 30 units, you've only given me 25, so we need another 5 units, so we're going to have to take that from the $12 rack. So you notice that once we give those units to the customer, we no longer have them in storage. So we no longer have those $10 units, and now we have fewer $12 units because we've sold them. So as you can see here, the cost of our sale is going to be 25 units that cost $10 each, plus another 5 units that cost $12 each. So to calculate the total cost of our sale, we'll take 25 times 10, which is $250, multiply 5 times 12, which is 60, and we're going to add those two together. To calculate the total cost of the sale, $310. Then we can also measure the revenue from the sale. We've sold 30 units, and each unit was sold at $25. So 30 times 25 gives us total revenue of $750. So in order to journalize this transaction, first to journalize the revenue side, we're going to debit accounts receivable for $750 and credit our sales revenue. Now to journalize the cost side, we've calculated the cost of the sale is $310 given the FIFO assumption. Once again, we can see visually that we gave the customer 25 units that cost $10 each, and then another 5 units that cost $12 each to make up the cost of the sale. So the cost of goods sold is $310, and you can see how I took it out of the inventory, so we want to credit inventory for $310. Now the next thing that's going to happen in our business is on March 8th, we're going to purchase, and we are going to purchase 20 units at $13 each. So the total cost of our purchase, 20 multiplied by 13, gives us $260. So our $13 units are in blue. So we're going to add our $13 units to our storage. We're purchasing 20 of them, so 5, 10, 15, 20. So we can now see that our inventory storage is only made up of $12 and $13 units because we have sold all of our $10 units. Excuse me while I arrange the inventory. Now the next thing that is going to happen is on March 13th, we're going to sell 40 units. And again, the sales price is going to be $25 each. So once again, we want to calculate the cost of the sale. So again, under the FIFO assumption, we are going to now assume that we are selling the 40 oldest units. So we're going to go from left to right physically. So the oldest units are our $12 units that come from our beginning inventory. 5, 10, 15 taken, and notice how they're taken away from our inventory and given to the customer. So we don't have them anymore, they're in the possession of the customer. 20, 25, and 30. Well, the customer is going to say to us, hey, can't you count? I asked for 40 units. You've only given me 30 units, so we have to give the customer another 10 units. So the only ones that we have to choose from are the $13 units. So for our sale on March 13th, we can now calculate the cost of the sale. We have sold 30 units that cost $12 each. You can see here, green 5, 10, 15, 20, 25, 30. So we have 30 units that cost $12 each, plus another 10 units that cost $13 each. So I'll calculate the total cost of the sale. $30 times 12 is $360, 10 times 13 is $130, and then I add them together, and I have $490 for the cost of the sale. And I can also once again measure the revenue from the sale. We've sold 40 units at a price of $25 each. So our revenue from the sale, $1,000. So just like we did before in the other journal entry, it's this exact same journal entry as over here, except for different amounts. So we're going to debit accounts receivable for the 1,000 and credit sales revenue for the amount of the sales revenue, 1,000. Now we have to journalize the cost side, and the cost of this sale is $490. So we're going to debit cost of goods sold for $490 and credit inventory $490. Now the next thing that is going to happen in our business is on March 17th, we are going to purchase another 25 units that cost $15 each. So we're going to purchase 25 units that cost $15 each. So the total cost of our purchase, $375. I'm going to go down to my $15 units. Those are the pink ones. And if I purchase another 25 of them, 5, 10, 15, 20, 25, I now have $13 units and $15 units in my inventory storage. So all I have to do is debit inventory and credit accounts payable for the purchase. $375, and as I was just muttering to myself, it looks like I forgot to do the journal entry for the purchase on March 8th. My apologies, but we do the same journal entry, we just debit inventory for $260 and credit accounts payable for the $260. Now the next thing that is going to happen is we are going to sell another 20 units on March 19th. So, we're going to sell our 20 units. We have to calculate the cost of the sale. So once again, under our Fifo assumption, we're going to assume that we sell our 20 oldest units. Well, our oldest units are the $13 units, so we take them out of our inventory storage and physically give them to the customer. but we give 10 of the units, the $13 units, the 10 we have left, and the customer says, "Can't you count? I wanted 20. So we take another 5 from the $15 pile and another 5 from the $15 pile. So as you can see visually, in this case, the cost of the sale we have 10 units that cost $13 each and 10 units that cost $15 each. So 10 times 13 gives us 130, 10 times 15 gives us 150. We add those two together and we get the total cost of the sale. $280. So once again, to journalize this, we're going to debit accounts receivable. Oh, excuse me, I didn't calculate the revenue from the sale, so give me a moment. The revenue from the sale is 20 units that cost $25 each. So $500. So we're going to debit accounts receivable for $500. Credit sales revenue for $500. Then we're going to debit cost of goods sold for the $280. And credit our inventory for $280. Inventory, not inventory T. Now, the last transaction that we have for the month is a purchase of 15 units at $17 right at the end of the month. $15 units at $17 each. So the total cost of our purchase, 15 multiplied by 17, gives us $255. And even though I forgot to do that journal entry before, all we need to do is debit inventory for the $255 and credit accounts payable. So we take our $17 units and we've purchased 15 of them. Excuse me, so we paste them 1, 2, 3. So now we can see visually exactly which units we've given to the customer, assuming our FIFO assumption that we're selling the oldest units first. So we can see that first we sell out of the $10 units, which were the oldest, then we sell out of the $12 units, which are the next oldest, then we sell out of the $13 units, which are the next oldest, then we go on to the $15 units. We didn't quite sell out the $15 units, and we have $17 units left, and you can see here visually that we have 30 units in our remaining inventory. Those are the units that have not been allocated to cost of goods sold. And you can work it out through the T accounts, or just take a look at the perpetual inventory records and see that our ending inventory is calculated as 15 units at $15 plus 15 units at $17 each. Okay, we will continue with the next recording for LIFO.